Welcome, everybody. I'm going to go through what is happening in the market and answer a question that has the market bottomed. So here, what you see is the performance of S&P 500 as of this morning on how it's been doing. So year to date, the market is down 8.4%, but a few interesting things happened. If you notice that on April 4th, which is right here, the stock market dipped 6%. So from the bottom of the previous day all the way to the bottom of that day, this was a minus 6% or a 6% dip. But soon after, very soon after that, we saw a jump to 9%. So market went down and then market went up by 9.5%. So what does this show? Remember, I have spoken about in the past that if you try to play the game of in and out of the market, you miss out on heavy performance days or heavy growth days. And if you miss out just a few of these, you end up actually losing a significant amount of growth potential. So here, this kind of worked out really by the book, essentially, of what ends up happening in the market. So 1 minute market went down, a significant drop, and a couple of days after, market went up by 9.5%. Now, interestingly, I happen to have some statistics on this, on some of the worst days and some of the best days that the market has seen. So you notice that this chart on the left side shows the total percent of returns and essentially the negative returns that S&P 500 has seen. So 2020 on the 16th of March, the market had dipped by 12% on a single day. Similarly, in 2008, went down by 8.9%. And this chart starts all the way from 1990. So there have been days that have been tracked. So these were the bad days. And here is April 4th, 2025, which is just a few days ago. And the market took a dip of minus 6%. Now, similarly, since 1990, here on the right side is a chart that shows which are some of the best days that the market has had since 1990. So you notice the 9th of April, which is just 5 days after the worst day in 2025, so far, the market went up by 9.5%. So even when I was looking at my portfolio that day when the market went up, I had to double take on my growth. I was like, wow, really? And then I had to check, is this number accurate? And it was accurate. But obviously, yes, because the market had taken such a huge jump. Similarly, other days when the markets had taken such major jumps, one was in 2008 when the market went up by 11.6%. In 2008, again, in October, the market went up by 10.8%. So this happened actually very, very soon after. So October 13th and October 28th, the market went up by very heavy 11.6% and 10.8%. And have a look at the other days as well. So in 2020, 9.4%. 2009, there was 7.1%, and so on and so forth. So these are some of the top days. Now, if one were to get bogged down by the slump that we had and some of the bad days or worst days that have been jotted down since 1990, that can really make people nervous. But it's very important to kind of step back and zoom out and see how markets have actually performed during all this time. So check this out. The market has overall done really well, and it's an exponential curve. And if you were to jot down the times when market did not do well, so look at this. So 2020 March. So here's 2020 March, somewhere around here. Well, market didn't do too well and then had a COVID dump. And then in 2008, for example, 9%. So where's 2008? 2008 is somewhere around here. Look at this, 9%. So these are all times the markets went down. But after that, the markets did recover. So that goes to show that staying in the market for the long haul can pay off. Sure, in the short term, the market misbehaves because in the short term, market is very emotional, but in the long run, markets go up to their intrinsic value. Now, here's a question, and this must be on many of your minds, which is, have we bottomed? Now, as you know, it's very difficult to say or answer that question because I don't have a crystal ball and nobody really has a crystal ball. They're all just speculations. But here's something that can give us an indication based on history, right? And if history were to play out, then maybe we can have some kind of an indication of where we are currently. So what is this indication that we can use? Well, this indicator is called the Kobe's VIX indicator or volatility index, ticker symbol VIX. And if you remember in my Telegram community, just last week, I threw a message and asked you all, do you know what VIX stands for? And why did I ask that? Is because I wanted to build that knowledge base in your mind so that we can have a sensible conversation about it today. So volatility index is an index that is created based on the prices of options. So as more people start to buy certain options, then what happens as the demand goes up, the price goes up, and that goes to show the volatility. So volatility, another word for volatility is fear index, but essentially what it means is as the volatility increases, the price change of the S&P 500 also increases. But historically, there has been a correlation that has been noticed. So, what has been noticed is as the volatility spikes, so I'll bring your attention to, let's say, this 2009 time frame. So, you notice as the volatility spikes, and the black line, by the way, represents volatility. So, as the volatility spikes and then it goes down, notice what happens to the S&P 500. S&P 500 goes up after that. Again, look at this, the COVID time. So when volatility went up and after going up, it goes down, the S&P 500 starts to go up. Now, of course, this up and down happens everywhere, but is there a certain level? And the answer is yes. If it crosses, let's say this point, and I have the number as well, which I'm going to show you, but it's roughly around 60. So when the volatility or the VIX crosses 60, and then it goes down and it goes down beyond, let's say around 34, 35, and it keeps going down below that, that's typically a time that has been seen historically when the markets turn around and they go up. And what that actually shows is when the market hits a volatility of 60, that means at that time the fear is significantly high. But when the volatility starts to go down, that means the fear starts to taper off. And when it goes below 34, 35, 33, and it stays there or continues to go down, that means the fear levels are going down. And when the fear level goes down, market starts to behave well because that volatility, the fear does not remain inside the minds of investors. So I had also a couple days ago shared a chart in our Telegram group where I went into TradingView and I showed you just historically when these kinds of dips, spikes and dips that happen, how the stock market behaved. So let's have a look at that, and I'm going to show you in more interactive fashion right now. So this is the S&P 500. The green line represents the S&P 500, and the candlestick on the top represents the volatility or the VIX index. So you notice this time. So this is a time frame of 2009. So in 2009, the market went down, right? And here's a volatility index. It had spiked up all the way north of 80 and it even had touched somewhere close to 96. But let's assume, because I have found a level which is 60, and this has also been shown in researches and studies, that when it crosses 60 and then it goes down, look at what happens. When it comes down, crosses about 34, 35, the stock market starts to do better. Now, did that get repeated again? Let's check again. Fast forward. This is the 2020. This is the COVID downturn. So notice when this S&P 500 was going down, look at volatility. People are very scared. The volatility index went up. And it crossed 60. When it went back down and started crossing down around 34, 35, notice what happened. After that, an uptrend was essentially established after that. Okay. Let's carry on, see if this again repeated. So we have again a time frame in 2024. So August 2024, notice VIX index again spiked, went beyond 60, and then it started going down beyond 33, 34, 35. And look at what happened. Here's a blue line, a vertical blue line I've carved. The stock market thereafter carved a path upwards. And what has happened recently? Recently, something very similar has happened again. Check out the volatility index. It touched 60, and now it has started to go down. And when it touched 60, look at the S&P 500. The S&P 500 had taken a big dump. But now it has again crossed below 34, 35. So we'll have to wait and watch. But it basically now shows that the fear in the market has gone down. In the short term, there is still a very high likelihood that the market is going to start keep misbehaving. But if the history were to act in the same way, then one can say that there is a possibility for that from this point onwards that the S&P 500 may carve a path upwards. Again, I want to caution you all that nobody has a crystal ball. I'm basing my assessment on how this specific indicator, which is the volatility index, has behaved in the past and what its observed correlation has been with the S&P 500.
Excuse me,
Okay.
Amit. Excuse me,
Yes.
Amit. This
Yes.
is Vijay.
Hi,
Uh,
Vijay.
the question I have is this. In the past, some of the big ones, 2008, 2009 was a financial crisis, 2020, COVID, and all of that seems to be, specific, big, huge events. Whereas this one seems to be, policy indicated, as you said. And so why would that follow similar? I would think it may not because the policy might change in a week and
You're
may
absolutely
not
right.
necessarily follow this, right?
You're absolutely right. And when I was trying to correlate this with the 2008 financial crisis, one could say, yeah, maybe there is correlation, but it was such a long, drawn out downturn. And at that time, there was also a correction in fair market values that was happening, or intrinsic values. There were flaws in the market which led to that crisis. Recently, what's been happening is these kinds, even like COVID, for example, COVID downturn uh, didn't have anything to do with the negativity or problems with companies. It was just fear induced. Similar to this time as well, the downturn in the economy, the stock market that has happened is not a result of any problems in businesses. It's artificially drawn out because of the policies that President Trump has taken. So the correlation with the VIX index may be more closely related this time around, similar to COVID, as opposed to the 2008 financial crisis, which took so long. Other thing to note is that whenever there is a parabolic drop in the stock market, it typically is followed by a fairly nice correction thereafter. In 2008, this was not a parabolic drop. In 2008, it was a very slow drop. So, for example, it started at the middle of 2007 and carried on until 2009, early 2010, and then the stock market turned around.
Hmm.
You follow?
Yeah, thank you.